We haven't had any dirty words on GIBS FN, so we're going to use some filthy words. They're four-letter words like debt, even dirtier, leverage. Filthy words, Graham Stokoe from Ernst & Young, with which you are intimately familiar, I suspect.
Yes, I guess so.
Now, leverage is, of course, crucial in the whole private equity space. Private equity, at one stage, it looked like every single company listed on the JSE was going to be delisted and private equity players were going to rule the world, but that came a little unstuck. Just remind us of that cycle and why it went so mad.
Well, if we go back to when that happened, that's, 2008, the banks getting into trouble, and really the banks sort of looking at their risk and not wanting to leverage. And, it's probably a fair point. Leverage is, however, important. It's just how much. And, private equity, I think, has learnt. Maybe not as much here, because South African private equity is generally, I would say, at least 10-15% lower leverage than UK, US, Europe.
But still, leverage has become a dirty word. Are we getting to a stage now where leverage is becoming a bit more acceptable? You don't sort of get gasped at in polite society when you use it.
Yeah, I think it is acceptable, and I think maybe in the wider world there are still memories of the dirty word. But in a business sense, leverage is important as well. It's doing clever business as well.
Now, take us through, and we haven't really explained why it all went wrong. Simply, the world was overgeared. There was too much borrowing. Companies were paying too high a premium to delist organizations, to delist companies. That happened to a couple of companies. I mean, Edcon, for example, is a prime local example.
No, that's right. But, I mean, we haven't seen the fallout of private equity portfolio companies. Yes, there's been a number of refinancings. But if you look at the collapse of the UK, US banks and stuff, you can't really isolate it to private equity at all. And what private equity has been able to do is bring in more equity. So instead of investments in new investments, there's been a lot of reinvesting into the current portfolio.
The conversion of debt to equity. Yes.
And I guess it's working out where is that, that right leverage level.
Has anybody figured that out yet?
I think, there isn't a right leverage level, and you need to pick the right companies. And, that's what, is key to a good private equity asset is a good cash generating asset. So it's going to vary, asset by asset. We've just heard of this year, actually, private equity doing full equity deals. That's the first time. That's in Europe, not here, and that's the first time I've ever heard of that.
Now, what's the significance of that, though?
I mean, the significance of that is that private equity is learning that they need to move forward, and that leverage can't be a stopping factor from private equity moving forward. Obviously, the significance is it's a lot harder to get the massive IRRs that they were getting in the boom times. But it's also about managing the risk, and you're not going to have boom times all the time.
The reality of buying up a company, ladling it with debt, or saddling it with debt, and then sort of waiting for management to work some kind of miracle and give you a return. I mean, have we realized that that is perhaps a stupid idea?
Yeah, I think we have realized that that is a stupid idea. But that's ladling it with debt, and that's why I say it depends on the level of debt. To say that a company should be 20% geared when 40% gearing could be a conservative level to grow the company. It's just capitalizing the business so it has the base to grow this company, and it's taking a lot of private equities, entrepreneurial businesses, family, and it's taking a lot of businesses to another level. And in order to take those businesses to another level, it is capital. And instead of capital from an equity perspective on listed markets, often it's coming out of debt. And that's not always a bad thing as long as you can manage the level of debt.
What are the big three things that you're looking at now in terms of private equity and in the way in which it should be done differently compared to what it was done in the past?
I think number one by far is how they manage the companies. So private equity in the past might have been more focused on the financial engineering of the company, getting the debt level right. Now there's so much more focus on running the company better, actually improving the growth, getting the cost base right, getting the markets right. So it's very much a focus on the company and a hands-on approach. And private equity has learned that, getting industry sector leaders as part of their teams, really a focus on a hands-on approach on their company, which, I think is slightly different from an equity model where shareholders just sit back. Private equity has really rolled up their sleeves and really got into the company and, really focused on it. If I think about the two other focus areas, it's probably on realizing a lot of exits. Maybe not last year, but going into this year, there's a lot of IPOs Europe here. We've seen one IPO here in South Africa. We're going to have to see more exits so that they can show the return.
Correct.
That they're able to show return now, post the economic crisis, as opposed to all these exits that happened in 06, 07, 08, a lot of the exits to other private equity buyers. And 09 was this sort of no exits, nothing happening. Now the focus is starting, we need to move forward. We need to actually show some returns in order to raise the next fund, because you're not going to be able to raise funds if you've got 9 investments, but you haven't actually exited out anything.
No, absolutely. What's going to happen to the cost of debt? We look at sovereign debt levels, for example, and we look at the crisis of Europe at present and the fact that there is really a concern and a threat of contagion across the European economic community. Is that going to affect the cost of corporate debt? It has to, surely.
It is going to affect it. And, the actions that have been taken so far, the interest rates are the lowest. They can't go lower. Right, here they can, but in Europe, US, if you think about what's happening in Greece, you can't take the interest rates lower, so you can't do any more to stimulate growth. So unfortunately, in the long or even in the medium term, the cost of debt is going to go up. And one thing we're saying is, there's a lot of refinancing that has to happen. And companies need to try to make that happen in the next sort of 6 months, a year, because after that, it's going to get more expensive.
A word of warning from Graham Stokoe. He is with Ernst & Young.